Will the housing market crash? Now that's a question many of us are asking ourselves and each other right now. Perhaps the best way to tell where the real estate realm is headed is by first understanding the factors that impact the housing market and also the indicators to watch. By gathering the facts, we'll help you separate myth from fiction to help you know if 2019 is the right year for you to buy or sell a home. My name is Andrew Finney, and my passion is helping you make sense of real estate. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. Thank you. Alright my friend, let's take a closer look and separate the myth versus fiction to help you know if 2019 is going to be the right year for you to buy or sell a home. Ultimately, the best time for you to buy or sell a home is when it makes sense to you and what's going on in your life. Certainly different market conditions can make it favorable or unfavorable to buy or sell a home. At the same time, when the time is right for you, that is the best time. After our conversation today, you'll know more about 7 key factors influencing the housing market, 7 key indicators to watch for trends in the real estate market, and 7 things we'll likely experience in 2019. For reference, I did a lot of research to make this video for you today, and if you want to take a closer look at all the different links that I used to compile this information to make it nice and easy to understand for you, please know that all the links are in the show more description below. Feel free to use them to draw your own conclusion of what's right for you. Okay, so let's take a look at the 7 key factors that influence the real estate market. The first one is the stock market. From the 2008 collapse, we learned a lot about the behavior of Wall Street and also the behavior of the financial market. One of the things that we learned is that what happens on Wall Street can also impact the real estate market, and what happens in the real estate market can impact what's going on with Wall Street and the financial sector. While it could be argued that no direct correlation exists between the two industries, we do know that the perception of what is going on in one can impact the other. Perhaps a more astute observation of what happened in 2008 is to take a look at the root causes that led into it by recognizing the practices, emotions, and perceptions during that time. By taking a closer look at this, we can learn from our mistakes and avoid another 2008. What we do know back then is that there were very lax lending practices. There was a lot of greed of hedge fund managers, and the government legislation at the time was empowering that behavior, in addition to the emotions of millions of Americans speculating that the market would only continue to rise. All of this fed onto itself, causing a perfect storm that led up to the 2008 collapse. Now you might be wondering, Andrew, what does this have to do with 2019? Turns out quite a lot as we continue learning about the factors that influence the market. By understanding that the health of the U.S. economy and Wall Street influence investor behavior and investor sentiment, it could ultimately result in higher mortgage interest rates or lower mortgage interest rates and the flow of money through our country. So the key observation to learn from what happened in the 2008 market is to keep proper perspective of each market, from Wall Street to the financial sector to real estate. They're all 3 different industries, so let's keep them in proper focus as we move forward. By doing so, we'll take the power away from those that would stoke fear and mislead us by perception, causing us to make ill-informed decisions opposed to well-informed decisions. It's important to remember that fear is only an acronym for false evidence appearing real. The best way to replace fear is with knowledge, and with knowledge comes power. With knowledge and power come comfort and confidence in yourself and in your abilities to make well-informed decisions that are right for you. No one can tell you what the right thing is except for you. So let's take that power back from the fear mongers and instill confidence and power within ourselves and in each other to make well-informed decisions that are going to be best for you and best for your loved ones moving forward. And in the process, dispel negativity and create positivity for ourselves, for each other, and for the sake of our country and economy. We can, we will, and we must do this for ourselves and for each other. The second factor to look at are mortgage interest rates. Even though mortgage interest rates today are slightly higher than we've seen in recent years, it's important to compare them to historical rates. This can easily be found on Freddie Mac's historical 30-year fixed rate mortgage rate table. To put this in proper perspective, let's consider the fact in 1981 the average mortgage interest rate was 18.45%, and the historical low was December of 2012 at 3.35%. So by averaging out all the numbers in Freddie Mac's chart, which by the way, yes I did, the 47-year average for a historical mortgage interest rate comes to 8.26%. Okay, so with all that wonderful information, what is Freddie Mac's thinking is going to happen in the mortgage interest rate world in 2019? Okay, so with all that wonderful information that Freddie Mac is making easily available to us for the 47-year average for a 30-year fixed rate mortgage, what does Freddie think is going to happen to mortgage mortgage interest rates in 2019. Right off of their website, they're forecasting that mortgage interest rates will climb to roughly 5.1% on average, as compared to an average mortgage interest rate of 4.6% in 2018. This is slightly higher than where we've been, at the same time well below the historical average of 8.26%. Of course, individual results may vary depending upon your income, your assets, your debts, and your credit score for your own unique circumstance. The best way to know for sure what interest rate you're going to get is talking with a local loan officer. The key observation here is with historic averages of 8.26% for mortgage interest rates, an interest rate climbing to 5.1% by the end of 2019 still means that we're well below the historic average, which means that we're likely to see mortgage interest rates continue to climb for the foreseeable future. The third influencing factor is home affordability. When we're looking at home affordability, we need to take a look at the appreciation rate in the United States for the average home. In 2018, the Zillow Home Value Index estimated that home appreciation in 2018 ended the year at 7.7% appreciation from the previous year. Zillow is also predicting that we'll see a 6.4% average home appreciation into 2019. But what does Freddie Mac have to say about this? Freddie believes that home appreciation was more along the lines of 5.1% for 2018 and is speculating that homes will appreciate at a rate of 4.3% in 2019. Yet in the same breath, with Zillow Group's 2019's predictions at the very bottom of that report, they mentioned they also conducted a survey of leading economists and housing experts that concluded they believe that the housing market will appreciate at a rate of 3.79% in 2019. Okay, so maybe one of the best things that we can do is simply break down the math to get the best idea of what we're likely to see in 2019. The first thing is that Zillow reports a 7.7% gain in 2018 with a forecast of 6.4% in 2019, while the Zillow surveyed group says that they believe that the market's going to appreciate at 3.79% in 2019. Freddie Mac believing that the home appreciation rate in 2018 was 5.1%, and in 2019 we'll see 4.3% average home appreciation. Using those numbers, let's come up with a middle ground from the different results that were there to get a good read on just what might happen. So that means that in 2018 we saw total home appreciation of 5.1 to 7.7%, or an average of 6.4%, with an estimated range for 2019 home appreciation of 3.79% to 6.4%, which averages out at 4.83% home appreciation for calendar year 2019. By looking at year-over-year averages from 2018 to 2019, we could expect to see roughly 1.57% less home appreciation moving forward through calendar year 2019. Okay, so what the key observation is telling us about home affordability is that with historically low interest rates and a cooling off of the rate of home appreciation in 2019, this could make it a great year for you to consider buying your new home as the market catches its breath from the sprint it's been on the last several years. The fourth factor influencing the real estate market are student loan debts. Student loan debts have risen from an estimated $500 billion in 2007 to a staggering $1.4 trillion in 2017, resulting in some 76% of millennials citing that their student loan debts are affecting their decision to wait to buy a house. For more information about that, please go to the show more description below and click on the link to the National Association of Realtors 2017 study of student loan debt and housing. Yet at the same time, even with that amount of student loan debts, millennials comprise 36% of all home buyers in 2018. That's up from 34% in 2017. In fact, some 65% of all first-time home buyers in 2018 were millennials. And another really interesting thing to note here is that the average age of a first-time home buyer in 2017 was 33, yet in 2018 the average age of a first-time home buyer is 32 years old. What does this mean? That means that we're seeing more and more people getting into home buying mode sooner than later, despite the student loan debt. When millennials were surveyed and asked about what caused them to decide to buy a home now rather than later, a lot of them just said, it's simply the right time in my life. We're just ready to buy. That's a very strong indicator of where the housing market is trending. Another interesting observation to be made here is that Generation Z is quickly on the heels of millennials. Generation Z is often those considered to be born from 1995 to 2010. That means that the older part of the Generation Z right now is roughly 23 years old. Between these two generations, we're going to see a massive change in the housing market moving forward with the amount of demand. Now, one of the things that makes Generation Z so interesting is that they account for just over 21% of the US population, and they are the most ethnically and racially diverse generation that we have ever had in US history. Right now, Generation Z is entering the housing market as renters, with 57% of Generation Zers saying that they would like to buy a home sooner than later. Ultimately, time will tell how this plays out. Yet with that amount of pent-up demand from Generation Z wanting to buy a home and the average age of a first-time homebuyer slowly coming down, it's going to be interesting to see what happens, and it's definitely a strong sign for our housing market moving forward. The key observation here is that while student loan debts present many challenges to first-time homebuyers, they are becoming more creative in exploring ways to purchase their first home, which is a great sign of consumer confidence from these two generations. The fifth factor that influences the real estate market is wage growth. According to the Trading Economics Digest of the U.S. Bureau of Economic Analysis, wages in the United States actually increased by a factor of 4.6% from September 2017 to September of 2018. For reference, the historical high in United States history was January of 1979 at 13.78% average wage growth. And the historical low was not so long ago in March of 2009 with a negative 5.88% average wage growth. The key observation from this data and this research indicate that at the 4.6% year-over-year gains in wage growth are that more Americans are earning more money and outpacing the current inflation rate of 2.2% by a factor of 2.4%. At the end of the day, that means that more people have more money for potential home buying or potential savings. The sixth factor influencing real estate is the unemployment rate itself. It comes as no surprise that the unemployment rate is considered a key performance indicator or simply a KPI of the economy. In 2018, Americans enjoyed a very low unemployment rate of 3.9% on average for 2018 and ending the year in December 2018 at a 3.7% unemployment rate. That's down from 4.4% unemployment in 2017. For reference, the historical high in the United States unemployment rate was 24.9% back in 1933, and the historical low was in 1944 of 1.2%. To put this in appropriate context, let's remember that in October of 2009, the unemployment rate peaked at 9.9%. So with 3.9% unemployment right now, that means that we have 6% more Americans to work. A key observation here to be made is that 6% more Americans are gainfully employed, earning more money than they have previously and beating the current rate of inflation. This is largely in part to the legislative activities that were passed underneath the Obama administration in 2010. This shows that the progressive legislative action taken by the Obama administration after the collapse of 2008 is working. It's important to remember that when Obama took office January 20th of 2009, the unemployment rate was 7.8%. When Obama concluded his service to our country, the unemployment rate was 4.8%. For reference, when the Electoral College voted Trump into the presidency, the unemployment rate was 4.8%, and as recently as December 2018, that was down to 3.7%. The seventh factor influencing the real estate market is the President of the United States. To put this in appropriate context, we need to take a look at the last 10 years of American history. Under the Obama administration, one key piece of massive legislation adding to the stability of the housing market was the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. Dodd-Frank was in direct response to the collapse of the 2008 market. This act ensured significantly more oversight of the financial sector, designed to put safeguards in place to prevent another 2008. The act further created the Consumer Financial Protection Bureau, often referred to as an acronym CFPB, in July of 2010, whose purpose is to protect consumers from unfair, abusive, or deceptive practices, and to take action against those breaking the law, including predatory mortgage lending. Under the Trump administration, President Trump had ran a campaign promise that pledged to repeal the Dodd-Frank Act, which is obviously much easier said than done. So as a workaround, on March 14th, 2018, passed a bill that would ease financial regulations and oversight of banks with less than $250 billion worth of assets, in a bill that's called S.2155 Economic Growth, Regulatory Relief, and Consumer Protection Act. This bill was ratified by the Republican majority-held House of Representatives on May 22, 2018, and signed into law by President Trump on May 24, 2018. Okay, what we can learn from this is a key observation that consumers need to be very careful exploring their loan options, including mortgages, to ensure that they understand and ask questions to clarify what they're agreeing to up front prior to owing any money. They should also be extremely wary of any lending programs that sound too good to be true. Remember, no one's going to give you a free lunch. There's always going to be a catch somewhere, so be sure that you keep a mindful eye of where that is and you understand how it impacts you moving forward to make well-informed financial decisions, including real estate and your mortgage options. By the way, you deserve massive kudos for just clicking on this video to get some of this education right now. Okay, so now that we know 7 key factors that influence the real estate market, let's take a closer look at the 7 key indicators to watch for market trends in 2019. I like to call this what makes the market tick, where tick is an acronym TIC for trends, indicators, and conditions. The first one is supply and demand trends. Now it's important to note that when we're talking about supply and demand trends, there are 3 main conditions for a real estate market. One housing condition is called a buyer's market. In a buyer's market, there are more homes available than there are qualified buyers in the market. The second is called a seller's market. In a seller's market, there are less homes for sale than there are demand by the buyers. And the third condition is called a stabilized market, when there's about an equal amount of homes in relation to the amount of home buyer demand in the market. As a pro tip, the HUD User's Office of Policy Development and Research, also known as PD&R, compiles nationally monthly indicators and releases them every month in what's called the National Housing Market Indicators Report. Again, the link is down in the show more description below if you want to check it out. Okay, you might be wondering, okay, Andrew, that's well and good, but what does this mean? The key observation to be made here is that with historically low interest rates and a slowdown of home appreciation, this could mean that this is the sign that you've been waiting for to get into home buying mode and decide if 2019 is the right year for you to buy your new place to call home. Either way, it's something to consider and it's something to think about. The second indicator are what are called LTV ratios, and LTV is simply an acronym for loan to value. When we're talking about loan to value ratios, it's simply a measurement of how much money buyers are putting down towards their new home, where a lower loan to value ratio is ideal. This means that more people are putting more money down on their home and they can afford to make these larger down payments, which result in a very strong signal to the market and is a very good indicator everything is going well in the housing market. To bring this to life, let's give you an example of how this would work. Let's say that a buyer is putting $30,000 down on a $300,000 home. Well, if you took $300,000 and you divide it by $30,000, you'd be left with 10%. Since the $300,000 would indicate 100% of the total loan amount, we would subtract it from the 10% they put down on the property, and that would equal a 90% loan to value ratio. According to Magnify Money by LendingTree, the average buyer using a conventional loan in 2018 put 10% down on their mortgage. A link to that study is in the show more description below. So what does this mean for you? As compared to 2009, when the average loan to value ratio was 97.53%. Remember, a lower loan to value ratio is a strong indicator for the market. The third indicator are debt to income ratios, often expressed as an acronym DTI. A debt to income ratio compares your total monthly debt payments in relation to your before tax total income, often referred to as simply gross income. The total monthly debt includes things like your proposed monthly mortgage, your property tax, your homeowner's insurance, and your HOA if it applies, and will include your minimum required payments for your credit cards, student loan debts if you have them, child support, alimony payments, car notes, credit cards, etc. At this point, it's probably going to be extremely helpful to know there are 2 types of debt to income ratios. One of them is called a front-end debt to income ratio, which is simply your proposed monthly mortgage payment divided by your total gross income. The second type is called a back-end debt to income ratio, or I normally like to call this your lifestyle ratio. What this means is that it's taking into account your total monthly debts in addition to your proposed monthly mortgage and combining it into a percentage and dividing it out against your total gross income. It's important to note that a low debt to income ratio is actually a very strong sign and a very strong indicator everything is healthy in the market and in the financial lives of people buying a home. As a side note here, I want to give you a very important pro tip as it pertains to understanding debt to income ratios and how it realistically impacts you. Buying a house at your maximum approved amount is not always a great idea. Consider how much you can comfortably afford moving forward with your home purchase. And remember that a debt to income ratio calculates off of your gross monthly income. In other words, that amount of money that you earn before taxes. When taking a holistic look and making your affordability decision, it's important to put in context when you see those ratios, it's not including that portion of your money that goes to Uncle Sam. To better determine how much you can afford, consider the important things like your basic necessities, your food, your gas, your child care if you have it, also your clothing that you need to have, and who can live without utility, right? Make sure that you plan this out correctly. Doing so will ensure that you don't end up house broke and ensure that you're setting yourself up for great financial health into the future. Don't let anyone push you to go to your maximum loan pre-approval amount if it's truly not something that you're comfortable with doing. At the end of the day, this is your shot to call, and you have to make the decision and live with the decision that you make that you're most comfortable with doing. The key observation here is that more and more home buyers are becoming more and more educated about the home buying ongoing process and understanding how the debt to income ratios impact them in their real everyday life. This is a wonderful thing as we step away from the maximum highs and people make more well-informed, well-rounded decisions that are right for them moving forward. The fourth indicator is what's called a notice of default rate. Notice of default is often represented as an acronym NOD. A notice of default is the first step in the foreclosure process and initiates when a homeowner has missed 3 mortgage payments. By keeping an eye on the notice of default rate in your local market is a strong sign of what's going to happen in the future. In addition to initiating the foreclosure proceedings, this is also when you hear of people then beginning to do short sales with the bank, essentially asking the bank to take less than what they owe on that property in the form of what's called a short sale. It's quite literally a short sale. You're asking the bank to take less. And also auction properties. All 3 of these, being your foreclosures, your short sales, and your auction properties, are considered distressed sales in a market. By watching the notice of default rate in your local marketplace, you'll have a better idea of what's taking place behind the scenes and what you're likely to see moving forward into the future with the amount of distressed sales. The more distressed sales on a market, the more apt that market is to become a buyer's market. This does get to be a little bit tricky though, because each state has their own laws about how long a bank can have a property before they must release it. Take for instance the state of Nevada. The state of Nevada gives banks up to 5 years after foreclosing on a property before they must sell that property in the open market. What this causes is a backup of what a lot of people refer to as shadow inventory. Being that this shadow inventory may not be released for 5 years into the future is an artificial way of controlling the market. But by keeping an eye on the notice of default rate, you can better prepare yourself in relation to how many that you're seeing. The greater amount of notice of defaults going out, the greater amount of distressed properties that will eventually come on the market. Planning and timing this out is a hallmark to reading the market. If you're wondering why the banks do this to artificially control a market, it's simple. Sometimes they're actually doing it because they're just really darn greedy and they want to get the best price when the market appreciates, and other times they're trying to keep the market stable. Now, it's in everyone's best interest to keep the real estate market as stable as possible. If they let all the homes go out on the market all at one time, it would cause a glut of homes, would throw us into a buyer's market, and it would mean that tens of millions of Americans are losing the equity in their home in that case. So it's important to understand a little bit of a dance here, but by recognizing the notice of default rate in your area, you can best prepare yourself moving forward with clarity and peace of mind. As a side note, when you see an increase on what's called days on market, or simply expressed as DOM as an acronym, it also indicates there's a change taking place in the market. The longer homes are on the market shows that the buyer demand may be there, but maybe the buyers can't get approved for the mortgage, or it could also show that buyer demand is starting to weaken. When days on market creep up higher and higher and higher, you begin leaving a seller's market behind and entering a stabilized market. They get really high. That's when you start going more into a buyer's market. It's important to watch what the average days on market is in your area for how long it takes a home to sell. The key observation here is to contact a local trusted real estate advisor that can keep you up to date with what's going on with the notice of default rate, and also let you know what the days on market are looking like so that you can plan out the timing of buying your house or selling your house. If you'd like to learn more information about real estate market cycle quadrants, please click the link below this point in the show more description below. The fifth indicator are builder incentives. So now you might be getting really curious about that and wondering, what the heck do builder incentives have to do with the real estate market, Andrew? Turns out quite a bit. These companies that are building homes across the United States are extremely savvy people. They have a team of economists that work for them that help them predict what's going on in the real estate market to know when to build or not to build and how much to build or not. When you see builders offering increased amount of incentives and dropping their own base price, it's a strong indication that they're reading the market, that they believe it's going to swing more towards a stabilized market or a buyer's market. At the same time, when you see builders pull back on the incentives that they're offering you, it's a strong sign that they're priming for a seller's market and they know they're going to be able to get the price they're asking for the house. Okay, so what does this mean to you? The key observation that can be made is by watching what builders are doing in your local marketplace can give you a strong read in where the builder believes the market is trending, helping you make a more well-informed real estate decision. The sixth indicator is called an absorption rate of homes. An absorption rate in real estate is perhaps best defined as the rate in which available homes are sold over a specific amount of time in a market. Oftentimes that period of time is simply a month. Let's break this down with a very simple illustration to help you understand how the absorption rate works in practice. Let's say in a fictional market there are 1,000 homes for sale, and in that same fictional market 250 homes very quickly sold in less than 30 days, marking our period time of 1 month. What we would do is take 250 homes that were sold and divide it by the 1,000 total available homes, and as a percentage we would receive 25% of an absorption rate. According to Investopedia, a sales seller's market is best indicated with an absorption rate of 20% or higher, while a buyer's market is indicated at 15% or less of an absorption rate. By knowing where you are on the absorption rate in the nation and also in your local marketplace is a very strong indicator to you of how to plan where the market is trending. It's important to note that an absorption rate is impacted by the same factors that influence the housing market, from mortgage interest rates to buyer demand to available home inventory and government legislation. So what does this mean to you? In practice, by watching the key observation of the absorption rate in your marketplace, you'll know exactly where your market is trending on the hyper-local level by a very simple equation of simply taking the total amount of homes available and dividing it by the total amount of homes that close within a given period. Again, let's call that period a month. It's the easiest way to do it, but of course you could extrapolate that out to any period of time that you like. By doing so, you'll know how your local housing market is doing. The seventh indicator are government activities and legislation. Government activities, along with other laws and legislation passed by the Senate and the House, can have a major impact on the real estate market. For example, if the Fed decides that it's going to continue raising the rates, what's that going to do to your home buying demand? It's going to make it a little bit more difficult for home buyers to get approved for a mortgage, depending on how high that mortgage interest rate goes. Keeping in mind that right now at the beginning of 2019, we're still historically low compared to the historic 47-year average of 8.26%. All the same, when the Fed adjusts the interest rates up or down, it is strong signals to the market of what to expect. The higher the Fed increases the interest rates, the more that we're inclined to head for stability, and also too high will lean over into a buyer's market. At the same time, when the Fed drops the interest rate, it frees up more cash flow across the country, providing more access and availability of home loans. At all times, you should always be prudent and do your own research to make a well-informed decision that's right for you. So what does this mean to you? The key observation that can be made here is to pay very close attention to what your elected representatives are doing and what they're saying. Watching what they're doing and saying with the legislation that impacts real estate and rates in specific can give you an indicator and insight of what to expect going forward in the marketplace. On a side note, what some people believe about mortgage interest rates is that they're a bad thing. Contrary to that point of view, they're actually a good thing. They provide stability into our market when it starts growing too quickly. If left unchecked, what happens is that mortgage interest rates remain low while home appreciation just keeps skyrocketing. What this is doing in the process is creating that bubble where you see more and more homes just rising in value that you know are unsustainable when they get to a point that the average American can't afford to buy a home. And that's part of how 2008 happened whenever it collapsed, and why it hurt so many people across so many industries, because it was the perfect storm. Avoiding that situation is a very good idea. I think we can both agree about that. So when the Fed is announcing a rate hike, I know it can feel like a thorn in the side sometimes, but just know it's providing stability to the US economy at large. In doing so, hopefully we can avoid another 2008 collapse from ever happening again in our lifetime. So what are the 7 things that we're likely to see unfold in 2019? The first thing is that based upon what we just covered with the factors that influence the real estate market and the indicators to watch for, we would know that the reality of a crash is highly unlikely to happen, barring any unforeseen or unpredictable geopolitical travesties, including war. The elephant in the room is the ongoing investigation of the Trump administration, which may erode both investor and consumer confidence. The second thing we'll see is that the housing market is currently witnessing a correction leading towards a stabilized market, where days on market will increase higher than we've seen in recent years, and home sellers will be wise to keep an open mind during the negotiating process, with the reality that likely a little bit more give and take than they're used to for the last few years is what's needed to find the common middle ground that everybody can agree to. The third thing we're likely to see is housing prices pull back in your local marketplaces to become more in line with fair market value. Open-minded sellers towards reasonable negotiations will fare well in this market. The fourth thing that we're likely to see is that home appreciation will continue to cool, but still appreciate. It's important to note that appreciation is what? Appreciation. In other words, that homes will still get more expensive, just at a slower pace. The fifth thing that we're likely to see is that rental prices will raise slightly as mortgage interest rates continue to rise, along with home appreciation. The sixth thing that we're likely to see is due to the Trump presidency. It is the one variable that gives pause to otherwise prudent research and logical decision-making processes. Given the current state of flux in the geopolitical realm, and depending on what Trump tweets next, could cause the market to swing sharply down, causing a buyer's market. Perhaps counterintuitive to many thinking that a buyer's market is a good thing. This is not a good thing to happen. Market extremes on both the seller's market and the buyer's market side of the house are unsustainable. The biggest hope that any of us could have is to continue the path towards stability, giving us a balanced market, which indicates a strong and robust economy. Striving for a balanced market for the next few years before the next real estate market cycle. The seventh thing that we're likely to see is an uptick in the increase in frequency of deceptive advertising geared towards people offering what sounds like too good to be true home loan options to people with low credit scores under a 580. This is in large part to the Republican majority held Senate and House of Representatives and Trump passing into law on March 24th the S.2155, which was the workaround to the Dodd-Frank Act put in place by the Obama administration to protect us consumers and protect us all from predatory lending practices. What does that mean for you? That means if something sounds too good to be true, it usually is. It also means that when you hear certain things out there that might sound like it's going to be your saving grace and what you really need in your life at the right time, be careful. Put your radar up and make sure that you understand what you're doing. Let us be smarter together so we don't repeat the issues that we had that led into the 2008 collapse. Be ready for it, be prepared for it, and keep yourself strong, and don't let somebody persuade you to make a decision. You know your mind, your heart, or your gut is not right for you. A few final thoughts about the housing market predictions for 2019 is that we are always stronger together than we are not. Let's continue to learn and grow together, helping everyone that we can to better understand how not to just survive, but thrive by making well-informed life decisions. Let's inspire positivity and be the reason someone smiles. Treating each other with kindness paves the way for a better and brighter tomorrow. We can, we will, and we must do better for ourselves and for each other. All right, my friend, thank you for sticking in there with me today. We have covered a lot of information. And now you might be wondering, okay, based upon the factors that are influencing the real estate market and the indicators to watch, I am thinking that this might be the right year for me to buy or sell a home. But what should I do next? Well, let's talk about that with 4 questions to ask yourself before buying a house and 3 questions to ask yourself to know if you're ready to sell a house. I'm looking forward to our next conversation. We'll see you in a few.